Welcome to this explainer. Let's jump right in. If you've ever dealt with the medical system, you know it's just a giant puzzle. It's notoriously complex, frustrating for the average patient, and honestly a massive headache for the insurers trying to manage it. But today, we're unpacking a really fascinating transformation. We are looking at Clover Health's ongoing shift from a traditional run-of-the-mill Medicare Advantage insurer into a highly profitable AI-driven healthcare operating system. Clover is attempting something incredibly ambitious here by putting proprietary software at the absolute center of their clinical model.
Okay, let's kick things off with a number that literally made the market do a double take: $27 million. Specifically, Clover just posted a positive GAAP net income of $27 million in the first quarter of 2026. To really put that into perspective, this represents a massive $29 million improvement year over year. For a company that has historically battled the same profitability struggles everyone faces when scaling an insurance business, this sudden leap into the black is a huge hook. It's a clear signal that something fundamental under the hood has actually shifted.
Here is our roadmap for today's explainer. 1. The turnaround to profitability. 2. The Medicare Advantage membership surge. 3. The Clover Assistant engine. 4. Pivoting to SaaS revenue. 5. Star ratings and quality. And finally, 6. Wall Street's mixed outlook. All right, Section 1. The turnaround to profitability.
You know, operating in the Medicare Advantage space is notoriously brutal. You've got razor-thin margins and constant regulatory pressure, so flipping from burning cash to actually generating a GAAP profit in this environment requires insane cost control and highly efficient care delivery. And Clover isn't just relying on one lucky quarter. Look at their full-year guidance for 2026. They are projecting total revenues pushing $3 billion, with a GAAP net income range between 0 and $20 million. This proves the turnaround isn't a fluke. It's built on solid, sustainable unit economics. Plus, their adjusted operating expenses actually dropped by 20% year over year. Basically, the top line is growing, but the overhead isn't dragging it down.
Moving right along to Section 2, Medicare Advantage membership surge.
To really understand how Clover is hitting these revenue numbers, we have to look at their customer base. They just saw a massive 53% year-over-year membership growth in their flagship Medicare Advantage PPO plans for 2026. 53%! And context is everything here. This surge happened during the enrollment period where the rest of the broader Medicare Advantage industry was actually retreating. While others were pulling back, Clover swooped in and captured serious market share.
And here's the kicker. This wasn't reckless growth. They reached over 153,000 total members, and over 97% of them are in those wide network PPO plans. Management noted this was highly disciplined growth, zeroing in on established core markets where they already have strong clinical networks. Combine that with a member retention rate of over 95%, and you've got a super sticky user base. Retaining members is absolutely vital in this industry, right? It sets the stage for compounding margins as those patients get healthier over time.
Which brings us to Section 3, the Clover Assistant engine.
So what's the actual mechanism driving these margins? It's their proprietary AI software platform, Clover Assistant. It creates this brilliant compounding effect. Check this out. In year 1 of a primary care doctor using the platform, a member's medical care ratio improves by about 8%. But let that bake until year 4, that differential explodes to a massive 20% improvement. And because Clover retains full underwriting risk, they pocket the entire financial upside as these patient cohorts mature.
Let's translate that financial jargon for a second. A lower medical care ratio simply means the insurer is spending less of your premium on actual medical claims. Why is it lower? Because Clover Assistant aggregates all this fragmented patient data and gives doctors real-time alerts right at the bedside. The AI literally helps doctors catch chronic diseases earlier and manage care proactively. That keeps patients out of the hospital, which avoids incredibly expensive bills down the road. It is textbook compounding cohort economics.
All right, Section 4, pivoting to SaaS revenue.
Now, this software engine has actually allowed the company to pull off something wild. They've built an entirely new business model. Clover is no longer just a traditional insurance carrier. Over 10% of their top-line revenue is now coming from software as a service, or SaaS, licensing. What was basically just a pilot program has blossomed into a legitimate high-margin revenue stream by early 2026.
They call this external SaaS product Counterpart Assistant. Essentially, Clover had a light bulb moment. If our software works to lower costs for our own insurance members, why not license it out to other doctors and even rival insurers? It's a strategic masterstroke. Monetizing their tech outside of their own plans gives them this high-margin financial buffer, protecting them against strict, ever-changing Medicare pricing regulations.
That takes us to Section 5, Star Ratings and Quality.
But hey, it's not all perfectly smooth sailing. As analysts, we need to balance this optimism with a reality check on the regulatory friction Clover is still facing. Medicare hands out star ratings that directly dictate federal bonus payments. For 2026, Clover's smaller HMO plan scored a strong 4.0 stars. But their flagship PPO plan, which holds 97% of their members, only managed a 3.5. While 3.5 is okay, missing that 4.0 threshold on the main plan leaves significant bonus revenues sitting on the table for the 2027 payment year.
Clover's management has been super vocal about this discrepancy. They stated, quote, "The star ratings methodology places disproportionate weight on non-outcomes measures rather than actual clinical outcomes and health improvements." The tension here is fascinating. Clover's internal clinical quality scores, their HEDIS metrics, are top tier. They actually rank #1 nationally for their PPO. Yet the government's STAR methodology leans heavily on administrative processes and member surveys. So you've got this frustrating gap between the real-world health improvements the AI is delivering and the official regulatory grade they receive. Finally, Section 6, Wall Street's Mixed Outlook. So, with all these moving parts, how is the broader financial market pricing in this turnaround story? Well, despite the positive GAAP net income and the new SaaS revenue, Wall Street is staying noticeably neutral. Analysts tracking the stock forecast a median price target of $4.20 for 2027, which is actually a slight decrease from its trading price at the time of the report. It reflects a very cautious, wait-and-see sentiment from institutional investors who might just be a little scarred by the company's past cash burns. Which leaves us with one massive lingering question. Can Clover's AI-driven SaaS pivot actually win over a skeptical Wall Street over the next 12 months? I mean, they've proven they can hit GAAP profitability, and they've proven outside providers will pay for their software. The ultimate test will be whether transforming into a capital-light healthcare operating system will definitively re-rate the company's future in the eyes of the market, regardless of the regulatory speed bumps. Thank you so much for joining me for this explainer. I hope this helped you decode the actual mechanics behind Clover Health's unique turnaround. Catch you next time.